We're reviewing the Investec Money Market Fund. It started its formation date, May 1997, and the manager, of course, Lisa Macloed, joining us now from Cape Town, and Vivienne, Taberer. Fund size 20.8 billion rand. Objective STeFI 3 months, and the TR sitting at 0.58%. So Lisa, let me start off with you and just talk to us about the objective of this fund and what it means for the type of assets that are included in it.
Well, the fund's primary objective is capital preservation. It sits in the traditional money market sector, so we are constrained by very, very tight controls. The maximum duration of the fund is 90 days, and the maximum instrument in which we can invest is 13 months. So as I mentioned, the primary objective is capital preservation, and then thereafter we would look to try and enhance the yield above a call or deposit rate.
I mean, this is interesting, okay? So this fund is nearly 21 billion rand worth of just money market assets, you know? And I mean, we often talk about the fact that larger fund sizes inhibit performance, especially when it comes to equities. Lisa, am I correct in assuming that money market funds size does not necessarily inhibit performance, doesn't matter how large this is?
I think size is important in money market funds, and in fact, the bigger the size of the money market fund and the size of fixed income assets within the manager's assets under management, the better negotiability we have and the more important player you are in the market. So in fact, size enhances returns where you are able to negotiate slightly better rates in the market.
So let's take a look at the returns. You've got that graph over there. I mean, 1 year return 5.4%, slightly below the STeFI 3 month, which is the benchmark, slightly above STeFI call rate. 2 years 5.6%, pretty much in line with the benchmark. 3 years 6.2%, slightly outperforming benchmark, and 5 years 8.1% versus 7.9%. So Roland, what are your views on these returns that we're getting here relative to, I suppose, what you might see in the equity markets?
Yeah, I guess you have to, these are fine margins that one has to deal with, but I guess that's the nature of a money market fund, is that you don't want to take too much benchmark relative risk, especially in this kind of category. I think we've got a graph of the rolling performance we'll have a look at in a moment, but Lisa, in terms of the underlying instruments, obviously these are banks that you're investing in, or that are paying you an interest rate for the cash that you are giving them. How would the credit rating changes to, for example, if you got money with Investec, which is now a global company, and their credit rating has changed, do you have to do anything immediately, or do you just sort of manage that yourself in terms of willingness to take that risk or not?
Well, certainly we have quite strict parameters in the type of investment grade credit that we can put into the fund. So if we did have a downgrade in one of the credits and it fell outside our mandate, we would have to remove that particular instrument. And in terms of removing it, we would obviously look to remove it in the most efficient way.
Is liquidity an issue in terms of getting in and out of these instruments, especially given your size of the fund?
Well, liquidity is particularly important in money market funds, and these type of funds typically have many redemptions and inflows into the fund. So liquidity is very important to consider when constructing the portfolio.
Yeah, I mean, let's just maybe quickly look at the rolling returns for this fund. You'll be familiar with the graph that you're looking at on your screen at the moment. It's the rolling 12-month returns for the fund relative to its benchmark. In this case, obviously, the benchmark is a STeFI 3-month return. And you can see, obviously, some underperformance. It's not always going to be outperformance relative to the benchmark, but certainly there's a vast period of time where there's been decent outperformance relative to the STeFI 3 months return. And you can kind of see how that looks at the end of the day. Just look at the scaling here. Again, you know, we're talking about something that is kind of finitely, something where you're finitely trying to add value as far as the returns are concerned. Also, maybe just look at it from a duration perspective. Where is this fund placed at the moment? And you can kind of see that the largest duration bet over here is probably on the very short end of the curve, anywhere between kind of 30 days all the way maybe up to 90 days worth of paper that the fund holds. I mean, Lisa, that's what you guys are trying to do obviously at the moment, is duration short rather than kind of going closer to the benchmark.
Yes, we've positioned the fund slightly cautiously. And obviously, in terms of constructing the portfolio, one needs to take into account implementing your strategic interest rate view, but also take into account the liquidity on the fund. The fund is mainly invested or the sweet spot in the fund is we have been buying 1-year bank floating rate notes where the duration on that instrument is less than 3 months, and that's why you see quite a big portion of the fund sitting in the sort of 90-day and less duration bucket.
I mean, how much of a view do you take into account in terms of the various banks and I suppose the underlying performances? Because it stands out that, of course, you don't have First Rand in here, but you have all the other big banks. You also have African Bank. Can you walk us through that? And then the heavy weighting towards Nedbank?
Yes, it's a function of what banks are paying in the market, where you think those spreads will move to. So yes, we certainly take a view in terms of where we would like to increase exposures at the margin, where we would like to decrease exposures. So, for example, the reason why we don't have First Rand is because the rates that they have been paying up in the market have not been that attractive relative to some of the other counterparties where we've invested.
I don't know, I don't know if you guys will bail me out, but I mean, the money market space is a tough space to be. You've got to get macroeconomics right. So we're not talking about bottom-up stock selection here. We're not talking about looking at company fundamentals.
You're not talking about, F&B and Steve or anything like that.
No, absolutely. No, absolutely. So you're trying to get the macroeconomics right. So you've got to have a seriously strong macroeconomic team that understands forecasting very, very well. Then you've got to get your midterm and your near-term bets right, and you've got to be able to be nimble enough in order to sway the duration in and out of your bet, so to speak, in order to make sure this thing kind of, that it kind of pays off long-term. I mean, Investec clearly has got a great track record. I take my hat off to you, Lisa, for being in this space, for the kind of returns you guys are making at the moment, and good luck there.
Thank you.